The volume spike didn't happen on Bitcoin, it happened on XRP, and almost nobody noticed. I remember watching the market that morning, like millions of other traders around the world. Bitcoin was dominating every headline again. Financial media was talking about institutional inflows, ETF momentum, and the next possible move toward new highs. Everything, every chart, every discussion, every piece of analysis was focused on Bitcoin. But something strange was happening in the background. While everyone watched Bitcoin's slow grind upward, XRP's order books were starting to behave differently. At first, it looked like normal activity, a few moderate buy orders, some scattered volume spikes, nothing dramatic enough to trigger alarms, but the pattern kept repeating. Buy pressure, small pullback, more buy pressure, another pullback. Then the volume started increasing. Not explosively, not in a way that retail traders would immediately notice. It was the kind of accumulation that happens quietly, slowly absorbing liquidity without pushing the price too far too fast. And that's when the first suspicion appeared. Because this wasn't retail behavior. Retail traders chase candles. They react emotionally. They pile into the market after the breakout. But this looked different. This looked like positioning. Large orders appeared during low volatility hours. Liquidity walls that had been sitting above the price for weeks suddenly disappeared, and wallets that had been dormant for months were suddenly active again. Meanwhile, the rest of the market remained distracted. Bitcoin was the story. XRP was an afterthought. At least, that's what it looked like on the surface. But when I started digging into the on-chain data, the timeline didn't match the narrative being discussed on television or social media, because the largest XRP wallets had begun accumulating days earlier, before the breakout, before the media noticed, before the market narrative had time to change. And the deeper I looked, the more unsettling the pattern became, because if XRP whales were already moving while the world was watching Bitcoin, then the real question wasn't whether XRP would move next. The real question was this: what did those whales see coming that the rest of the market completely missed? Financial markets have a habit of distracting investors. When one asset captures the spotlight, everything else fades into the background. Traders become hyper-focused on the dominant narrative, often ignoring subtle shifts happening elsewhere. At that moment, Bitcoin was the center of attention. Institutional flows were increasing. ETF-related discussions dominated financial media. Every analyst on television seemed to be talking about the same thing: Bitcoin's next potential move. And that focus created a blind spot. Because while attention was concentrated on Bitcoin, XRP was quietly entering a different phase of its market cycle. The first signal appeared in the price structure. For weeks, XRP had been trading in a narrow range, bouncing between support and resistance without any clear direction. Many traders interpreted this as stagnation, but sideways markets often hide accumulation. Experienced investors understand that strong trends are frequently preceded by long periods of quiet positioning. During these phases, larger players gradually build positions while volatility remains low, and that's exactly what the XRP chart began to show. Each dip was being bought faster, each sell-off was becoming weaker. The market wasn't exploding upward, but it also refused to break down. That kind of behavior suggests one thing: demand, not emotional demand, strategic demand, and someone was clearly accumulating. The only problem was that almost nobody was paying attention, because when the world watches one asset, the real opportunity often develops somewhere else. Price action can be misleading. Wallet data rarely is. When analysts began examining XRP's on-chain activity during that period, one detail quickly stood out. Several large whale wallets had suddenly become active again. These weren't random retail addresses. They were long-established wallets holding tens of millions, sometimes hundreds of millions, of XRP. And their behavior had changed. For months, many of these wallets had remained relatively quiet. Transactions were minimal, suggesting long-term holders simply maintaining their positions. But then the transfers started appearing: large inflows, repeated purchases, strategically timed accumulation events. Interestingly, these transactions often occurred during periods of low market activity. times when retail traders were least active and market noise was minimal. Late-night U.S. trading hours, early Asian sessions, moments when large transactions could happen quietly without attracting immediate attention. This pattern wasn't accidental. Institutional traders often prefer low liquidity windows because they allow significant positions to be built without dramatically affecting price. And that's exactly what appeared to be happening. The whales weren't chasing the market. They were positioning ahead of it. And by the time XRP's price finally started responding, their positions were already established. Retail traders rely heavily on visible momentum. They look for explosive price moves, trending headlines, and social media excitement before entering the market. But the XRP accumulation phase produced none of those signals. The price was moving slowly. The headlines were quiet. The broader market was distracted, which meant the early signals were easy to ignore. Even experienced traders overlooked them. Most assumed the sideways movement meant XRP lacked interest compared to other crypto assets attracting institutional capital. But the order books told a different story. Sell walls began shrinking. Buy orders appeared more frequently, and the price gradually started forming higher lows. These subtle signals rarely trigger immediate excitement, but they often appear right before significant market moves. Because when accumulation finishes, supply disappears. And once supply disappears, even moderate demand can push prices higher very quickly. The market was getting closer to that moment. Retail simply hadn't noticed yet. One reason XRP had been ignored for so long was regulatory uncertainty. The legal battle between Ripple and the U.S. Securities and Exchange Commission had created a cloud over the asset. Institutional investors dislike regulatory ambiguity. Compliance departments prefer clarity. And for years, XRP represented exactly the kind of legal uncertainty many institutions avoid. But something about the regulatory environment appeared to be shifting. Legal discussions were evolving. Certain enforcement narratives were losing momentum. And perhaps most importantly, the market's reaction to regulatory developments was changing. Instead of reacting with panic, XRP was beginning to show resilience. Prices were stabilizing rather than collapsing after legal updates. That shift in behavior may seem subtle, but markets often begin pricing in regulatory outcomes long before official decisions arrive. And if institutions believed the worst regulatory scenarios were becoming less likely, their investment strategies would naturally begin adjusting, quietly, before the public narrative caught up. Large institutions rarely act suddenly. They move gradually, carefully, strategically. As XRP's accumulation phase progressed, several indicators suggested institutional participation might be increasing. Trading volume became more consistent, price movements became less erratic, and volatility began compressing, a common sign that stronger hands are entering the market. Unlike retail traders, institutions typically build positions slowly over extended periods. Their goal isn't quick profit, their goal is positioning. When enough institutions begin accumulating an asset simultaneously, the market structure changes. Supply tightens, liquidity shifts, and eventually the asset enters a new phase of price discovery. The XRP market was beginning to show signs of exactly that transition. Volume tells stories that price alone cannot. When analysts examined XRP's trading activity during the accumulation period, they noticed a remarkable pattern. The largest bursts of buying volume were not happening during peak trading hours. They were happening when the market was quiet. Late-night sessions, early morning hours, periods when retail participation was minimal. This is not unusual for institutional trading strategies. Professional desks often execute large orders during quieter market conditions because price impact is easier to control. And in the XRP market, those quiet hours were becoming increasingly important, because that's when the whales were most active. Financial narratives rarely change gradually, they flip. One day the market ignores an asset. The next day analysts suddenly call it a breakout candidate. This shift usually happens after price action becomes impossible to ignore. And eventually, that moment arrived for XRP. The accumulation phase ended, resistance levels broke, volume surged. Suddenly, the asset that few people were watching became the center of discussion. Analysts began explaining the move. Media outlets started mentioning XRP again. Retail traders rushed to understand what had happened. But by then, the most important phase of the move had already occurred. The whales had positioned themselves long before the narrative changed. Financial markets reward preparation more than reaction. By the time an opportunity becomes obvious, much of the advantage has already disappeared. The XRP situation revealed a pattern that appears repeatedly across financial history. Public attention follows price. Smart money often moves before it. While millions of traders were watching Bitcoin dominate the headlines, a quieter story was unfolding elsewhere in the market. Whale wallets were waking up, liquidity was shifting, and XRP was quietly entering a new phase. The lesson isn't simply about XRP, it's about market psychology. Investors naturally focus on the asset everyone is talking about, but sometimes the most important movements happen in the places nobody is looking. And the real question every investor must eventually ask is this: are you following the headlines? Or are you watching the signals that appear before the headlines exist?